Question 1. Insurance contracts, policy provisions and exclusions. A policyholder files a claim for damage caused by a flood, but the insurer denies the claim based on an exclusion in the policy. Which of the following best describes why the claim was denied and how exclusions in insurance policies are applied? Exclusions are policy provisions that limit coverage for certain perils, and flood damage is typically excluded under standard homeowners insurance policies. B. Exclusions apply only when the policyholder fails to disclose important information during the application process. C. Exclusions are temporary clauses that insurers must remove if the policyholder submits a formal request. D. Exclusions apply only if the insured did not pay premium on time. Answer A. Explanation. Exclusions in insurance policies are specific provisions that eliminate coverage for certain perils or risks. In this case, flood damage is typically excluded under standard homeowners insurance policies unless the policyholder has a separate flood insurance policy. According to New York insurance law section 3425, insurers must clearly state exclusions in the policy. Option B is incorrect because exclusions are not related to the disclosure of information. Option C is incorrect as exclusions are permanent unless an endorsement is added to modify the policy. Option D is unrelated to the applicability of exclusions. Question 2. Scenario-based. Consumer Protection Laws, Free Look Period, MS. Samantha Brown purchases a life insurance policy in New York. After reviewing the policy documents, she feels the coverage does not meet her needs. She decides to cancel the policy after 9 days. The insurer denies her request to cancel, claiming the policy is already in force. What should MS Brown do next based on New York consumer protection laws? A. MS Brown has the right to cancel the policy within 10 days from the date of receipt under the free look period rule. B. MS Brown cannot cancel the policy once it is in force, as the free look period only applies before the policy is issued. C. MS Brown must keep the policy for at least 1 year before she can cancel it. D. MS Brown should file a lawsuit against the insurer for denying her claim. Answer. An explanation. In New York, policyholders are granted a free look period of 10 days from the date they receive the policy to cancel it without any penalty, as stated in New York Insurance Law Section 3209 B1. MS Brown is within her rights to cancel the policy during this period. Option B is incorrect because the free look period applies after the policy is issued. Option C is false as there is no requirement to keep a policy for 1 year. Option D is incorrect and extreme, as filing a lawsuit is unnecessary in this situation. Question 3. Insurance fraud prevention. Types of fraud. Which of the following scenarios would be classified as soft fraud under New York insurance regulations? A. A policyholder intentionally stages a car accident to collect insurance money. B. An insured person exaggerates the value of items lost in a fire when filing a claim. C. An agent steals premium payments and fails to remit them to the insurance company. D. A person purchases a life insurance policy for someone who does not exist. Answer. B. Explanation. Soft fraud involves exaggerating legitimate claims to receive a larger payout than the actual loss, such as inflating the value of items lost in a fire. This is distinguishable from hard fraud, which involves deliberate and premeditated acts like staging accidents, option A, or creating fake policies, option D. Option C refers to embezzlement, which is a criminal act but not categorized as insurance fraud under New York insurance fraud statutes. Question 4. Personal lines insurance, homeowners insurance. Liability coverage. The delivery person slips on icy stairs at Mr. Thompson's home and sustains injuries. The delivery person sues Mr. Thompson for medical expenses. Which section of Mr. Thompson's homeowner's insurance policy would cover the lawsuit? A. Coverage. Dwelling coverage. B. Coverage B. Other structures. C. Coverage C. Personal property. D. Coverage E. Personal liability. Answer. D. Explanation. Coverage E. Personal liability in homeowners policy provides protection if policyholder is held legally responsible for bodily injury or property damage to others. In this case, the delivery person's injury would be covered under this liability section. Option dwelling coverage covers the physical structure of the home. Option B, other structures, covers detached structures like garages. Option C, personal property, covers the insured's belongings, not liability claims. Question 5. Health insurance, accident and health insurance policy provisions. Which of the following provisions in a health insurance policy requires an insured to pay a specified amount out of pocket before the insurance company covers the remaining medical expenses? A. Premium. B. Copayment. C. Deductible. D. Coinsurance. Answer. C. Explanation. A deductible is the amount an insured must pay out of pocket before the insurer begins to cover medical expenses. Once the deductible is met, the insurer pays according to the policy terms. A premium, option A, is the payment made to maintain the policy. A copayment, option B, is a fixed fee paid for specific services. Coinsurance, option D, refers to the percentage of costs the insured pays after the deductible is met. Provisions are governed by New York Insurance Law Section 3216. Question 6. Scenario-based. Claims process settlement practices. Scenario: Mrs. Laura Evans' home was damaged by severe storm and she filed claim with her homeowner's insurance company. The claims are just to visit her property and offers her settlement significantly lower than the repair estimates she obtained. Mrs. Evans feels the offer is unfair. What should Mrs. Evans do next to address the issue according to New York's claims settlement practices? A. Accept the settlement offer to avoid delays and disputes. B. File complaint with the New York Department of Financial Services. C. Withdraw her claim and pay for the repairs herself. D. Wait for the insurance company to increase its offer voluntarily. Answer. B. Explanation. According to New York Insurance Law Section 2601, insurers must engage in fair claim settlement practices. Mrs. Evans has the right to file a complaint with the New York Department of Financial Services if she believes the settlement is unfair. Insurers are prohibited from offering unreasonably low settlements. Option is incorrect because accepting a low offer would waive her right to dispute. Option C is unnecessary. Option D is ineffective, as insurers are not obligated to increase offers without further action. Question 7. Ethical practices and standards. Suitability of insurance products. An insurance agent in New York recommends a life insurance policy to a 75-year-old client with a limited income. The policy has a high premium and includes a cash value feature the client is unlikely to use. Which ethical guideline is the agent potentially violating? A. Fiduciary duty. B. Suitability requirement. C. Free look provision. D. Replacement disclosure. Answer. B. Explanation. The suitability requirement mandates that insurance agents recommend policies that fit the client's financial situation, needs, and goals. In this case, recommending high premium policy to an elderly client with limited income may not be suitable. Fiduciary duty, option A, refers to the responsibility to act in the client's best interest, which overlaps with suitability. Free look provision, option C, allows cancellation within specified period. Replacement disclosure, option D, applies when an agent recommends replacing an existing policy with new one. Question 8. Commercial lines insurance, commercial general liability, CGL policy. Which of the following is an example of a personal and advertising injury covered under a commercial general liability CGL policy? A. Damage to a customer's vehicle parked at business location. B. Business being sued for slander by competitor. C. Customer slipping and falling inside store. D. Fire damaging the insured's office building. Answer. B. Explanation. Personal and advertising injury liability under a dealer policy covers non-physical injuries such as defamation, slander, and libel. Option B is correct because slander is covered under this provision. Option is covered under premises liability. Option C falls under bodily injury liability. Option D is covered under commercial property insurance, not the liability portion of a deal policy. Question 9. Insurance fraud prevention. Role of the New York DFS. What is the primary role of the New York Department of Financial Services DFS in insurance fraud prevention? A. Prosecuting policyholders who file claims. B. Issuing licenses to insurance agents and brokers. C. Detecting, investigating, and preventing insurance fraud. D. Settling disputes between insurers and policyholders. Answer. C. Explanation. The New York Department of Financial Services DFS is responsible for detecting, investigating, and preventing insurance fraud. It oversees compliance with state laws to ensure that insurers and policyholders act ethically and lawfully. Option is incorrect because the DFS does not directly prosecute individuals. It refers cases to law enforcement. Option B is a regulatory function but not specific to fraud prevention. Option D involves dispute resolution but is not the DFS's primary role in fraud prevention. Question 10. Consumer protection laws. Right to cancel. Life insurance. In New York, how many days does a policyholder typically have to cancel a life insurance policy after receiving it under the free look provision? A. 5 days. B. 10 days. C. 15 days. D. 20 days. Answer. B. Explanation. Under New York Insurance Law Section 3209, B.1, life insurance policies are subject to a 10-day free look period. During this time, policyholders can review the policy and cancel it for a full refund if they are not satisfied. Option is too short. Options C and D exceed the typical free look period granted under New York law. Question 11. Commercial auto insurance. Symbol usage in business auto policy. Which of the following symbols in a business auto policy BAP provides the broadest coverage for liability? A. Symbol 1. B. Symbol 2. C. Symbol 7. D. Symbol 9. Answer. A. An explanation. Symbol 1 provides the broadest liability coverage under a business auto policy as it applies to any auto whether owned, hired, or non-owned by the insured. Symbol 2 applies only to owned autos, Symbol 7 applies to specifically described autos, and Symbol 9 applies to non-owned autos only. Question 12. Ethics, twisting and churning. What is the primary difference between twisting and churning in unethical insurance practices? A. Twisting involves replacing a policy from a different insurer, while churning involves replacing a policy within the same insurer. B. Twisting is illegal, but churning is legal. C. Twisting applies to life insurance, while churning applies to property insurance. D. There is no difference between twisting and churning. Answer. A. Explanation. Twisting is the unethical practice of persuading a policyholder to replace a policy from one insurer with a new policy from another insurer using misleading or false information. Churning involves replacing an existing policy within the same insurer to generate additional commissions without benefit to the policyholder. Question 13. Workers' compensation. Covered injuries. Which of the following injuries would typically not be covered by a workers' compensation policy in New York? A. An employee slips and falls while working on a job site. B. An employee develops carpal tunnel syndrome due to repetitive work tasks. C. An employee sustains injuries during a lunch break at a nearby restaurant. D. An employee suffers a back injury while lifting heavy equipment at work. Answer. C. Explanation. Workers' compensation generally covers injuries that occur within the scope of employment. An injury sustained during a lunch break at an off-premises location such as a restaurant would not typically be covered unless the employee was conducting business for the employer during that time. Question 14. Property insurance. Actual cash value versus replacement cost. What is the main difference between actual cash value (SCV) and replacement cost (RC)? A property insurance policy. A. SCV includes depreciation while RC does not. B. RC includes depreciation while SCV does not. C. SCV covers the market value of the property while RC covers the appraised value. D. There is no difference between SCV and RC. Answer. An explanation. Actual cash value (SCV) takes depreciation into account when calculating the payout for a covered loss. Replacement cost (RC) provides the amount necessary to replace the damaged property without deducting for depreciation. Question 15. Scenario-based claim settlement delay. Mr. James filed a claim for roof damage caused by a storm. The insurance company has acknowledged receipt of the claim but has not provided a settlement offer within the legally required time frame. What action can Mr. James take under New York's unfair claims settlement practices regulations? A. Sue the insurance company for the full amount of his claim. B. Demand immediate payment of the full policy limit. C. File complaint with the New York Department of Financial Services. D. Withdraw his claim and file new one. Answer. C. Explanation. Under New York Insurance Law Section 2601, insurers must comply with timely claim settlement practices. If a claim is delayed unreasonably, the policyholder can file a complaint with the New York Department of Financial Services. Question 16. Inland marine insurance. Cover property. Which of the following items would typically be covered under an inland marine policy? A. A house damaged by a flood. B. A company's fleet of delivery trucks. C. Contractors' tools and equipment used on multiple job sites. D. Office furniture in fixed location. Answer. C. Explanation. Inland marine insurance covers movable property that is frequently transported or used at various locations, such as contractors' tools and equipment. The other options are covered by different types of policies, such as homeowners insurance or commercial auto insurance. Question 17. Life insurance. Grace period provision under New York insurance law. How long is the grace period typically provided for a life insurance policy before it lapses due to non-payment of premiums? A. 10 days. B. 15 days. C. 31 days. D. 60 days. Answer. C. Explanation. The grace period for life insurance policies in New York is generally 31 days, during which the policyholder can pay the overdue premium without the policy lapsing. Question 18. Auto insurance. No-fault insurance in New York. Which of the following expenses is typically covered by no-fault insurance in New York? A. Repairs to the insured vehicle. B. Medical expenses for the insured driver and passengers. C. Property damage to a third party's vehicle. D. Legal defense costs in liability lawsuits. Answer. B. Explanation. No-fault insurance in New York covers medical expenses for the insured driver and passengers regardless of fault in an accident. It does not cover vehicle repairs or liability-related costs. Question 19. Professional liability insurance. Errors and omissions. A real estate agent provides incorrect advice to a client, resulting in a significant financial loss. Which type of insurance policy would protect the agent from liability in this situation? A. General liability insurance. B. Errors and omissions EO insurance. C. Commercial property insurance. D. Directors and officers DO insurance. Answer. B. Explanation. Errors and omissions EO insurance provides protection for professionals against claims of negligence or inadequate work that result in financial losses for their clients. Question 20. Flood insurance. National Flood Insurance Program. Which entity administers the National Flood Insurance Program? NFIP, FEMA, B. HUD, C. FDIC, D. SBA. Answer. A. Explanation. The National Flood Insurance Program, NFIP, is administered by FEMA, Federal Emergency Management Agency. It provides flood insurance to property owners in participating communities to reduce the financial impact of flood-related damages. Question 21. Commercial property insurance. Coinsurance clause. A business owner insures their commercial property for $400,000 under a policy with an 80% coinsurance requirement. The property's replacement cost is $600,000. After a fire causes $120,000 in damage, how much will the insurer pay, assuming no deductible? A. $120,000. B. $100,000. C. $80,000. D. $60,000. Answer. B. Explanation. The coinsurance requirement states that the insured must carry insurance equal to at least 80% of the property's replacement cost to receive full compensation. The insured should have carried $480,000, 80% of $600,000, but they only carried $400,000. The formula to determine the payout is insurance carried insurance required x loss. It's $480,000 x $120,000 equals was $100,000. Question 22. Auto insurance minimum liability limits in New York. What are the minimum liability limits for auto insurance required by New York State Law? A. 15-30-10. B. 25-50-10. C. 25-50-25. D. 50-150. Answer. B. Explanation. New York requires drivers to carry minimum liability limits of $25,000 for bodily injury per person, $50,000 for bodily injury per accident, and $10,000 for property damage. Question 23. Scenario-based business interruption insurance. A manufacturing plant is forced to close for 2 months after a major fire. The closure results in significant loss of income and extra expenses to resume operations. Which type of commercial property coverage would help the business recover these financial losses? A. Equipment breakdown insurance. B. Business interruption insurance. C. Ordinance or law coverage. D. Inland marine insurance. Answer. B. Explanation. Business interruption insurance provides coverage for lost income and extra expenses incurred when a business is forced to close due to a covered loss, such as a fire. Question 24. Ethics rebating. Which of the following practices is considered rebating and is generally prohibited in most states? A. Offering a client a discount on premiums for early payment. B. Providing free promotional items worth less than $25. C. Giving a portion of the agent's commission to the client as an incentive to purchase a policy. D. Offering additional coverage at no extra cost. Answer: C. Explanation. Rebating involves offering financial incentives to clients in exchange for purchasing an insurance policy. It is generally prohibited to protect consumers from unethical sales practices. Question 25. Scenario-based homeowners insurance and liability coverage. A homeowner's dog bites delivery person, causing medical expenses and lost wages for the injured party. Which section of the homeowner's insurance policy would respond to this claim? A. Dwelling coverage. B. Personal property coverage. C. Personal liability coverage. D. Medical payments to others. Answer: C. Explanation. Personal liability coverage in a homeowner's policy covers bodily injury or property damage for which the insured is legally responsible. The medical payments to others section may also provide coverage for medical expenses, but it does not cover lost wages. Question 26. Flood insurance. Waiting period. What is the standard waiting period for flood insurance coverage to become effective under the National Flood Insurance Program (NFIP)? A. 7 days. B. 14 days. C. 30 days. D. 60 days. Answer: C. Explanation. The NFIP requires a 30-day waiting period before flood insurance becomes effective unless the policy is purchased in connection with a loan closing. Question 27. Workers' compensation exclusive remedy doctrine. What does the exclusive remedy doctrine in workers' compensation law mean for employees? A. Employees can sue their employer for additional damages beyond workers' compensation benefits. B. Employees cannot receive workers' compensation benefits if they have health insurance. C. Workers' compensation benefits are the only compensation employees can receive from their employer for a work-related injury. D. Employees must prove employer negligence to receive workers' compensation benefits. Answer: C. Explanation. The exclusive remedy doctrine states that workers' compensation benefits are the sole compensation employees can receive from their employer for work-related injuries, preventing them from suing the employer in most cases. Question 28. Scenario-based umbrella insurance policy. A policyholder has $300,000 in liability coverage on their homeowner's policy. They are sued for $800,000 after a serious accident on their property. How much of this loss would be covered by an umbrella policy, assuming the policyholder has a $1 million umbrella policy with no underlying coverage gaps? A. $300,000. B. $500,000. C. $800,000. D. $1 million. Answer: B. Explanation. The homeowner's policy covers the first $300,000 of the liability claim. The umbrella policy would cover the remaining $500,000 up to its policy limit. Question 29. Cyber insurance coverage components. Which of the following is typically not covered by a cyber liability insurance policy? A. Data breach response costs. B. Regulatory fines and penalties. C. Damage to physical property caused by a cyber attack. D. Legal fees associated with a cyber lawsuit. Answer: C. Explanation. Cyber liability insurance covers data breach response costs, legal fees, and regulatory fines. However, it does not cover damage to physical property, which would be covered under a different type of policy. Question 30. Health insurance coordination of benefits. What is the purpose of a coordination of benefits (COB) provision in health insurance policies? A. To determine which policy covers pre-existing conditions. B. To avoid overpayment of claims when a person is covered by multiple policies. C. To exclude coverage for dependents over the age of 26. D. To ensure that the policyholder receives the maximum benefit from each policy. Answer: B. Explanation. The coordination of benefits (COB) provision ensures that no more than 100% of the claim is paid when an individual is covered by multiple health insurance policies. It helps prevent overpayment and duplicate claims.